basically we're going through the antithesis of what we had gone through over the last, dozen plus years, where previously the global central banks have been in a posture of liquidity infusion, infusing liquidity into the market, 25 plus trillion dollars, obviously accelerated with COVID, and that was to stabilize the global financial system. And, that's not without collateral effect, right? So the initial collateral effect was massive asset price inflation. We saw that in the form of stocks. We saw that in the form of cryptocurrencies, the proliferation of 18,500 different cryptocurrencies. We saw that in probably most logically and notably in the bond markets, the sovereign bond market, sovereign debt markets. I think that there was a time when there was over $19 trillion of sovereign debt that was trading at a negative nominal yield. I know that German bonds, for example, traded at negative 70 basis points. I mean, that's just not a natural market. That's just not, no rational person is buying government debt and paying 70 basis points a year for them to hold it. It was a function of an ocean of liquidity that was in the market that needed to find a home. And the collateral effect was massive asset price inflation. Now, nobody was complaining. Nobody was unhappy. No market participants, no central bankers were unhappy, when markets go up because people are generally doing well. The problem is that there was a secondary collateral effect, which has now become consumer price inflation. So we're seeing, I think I wrote that quote that you mentioned back in maybe January when it was 7% or even December. But, now we're running 8% or even north of 8% in the US. I think the UK is at 10%. I think the EU is at around 8%. So we're seeing it globally. We're seeing the collateral effect being consumer price inflation, which is not a good thing. And it's something that the central banks have to respond to. So in order for me to have, wanted to launch this fund, because I'm going to use a funny word, market prices have been wackadoodle, for years. I mean, 5-year notes trading at 20 basis points or, 10-year notes even trading around that level. I don't know how low they got exactly. Like I said, 19 trillion of sovereign debt trading at negative interest rates. I mean, are wacky prices, but if something is overvalued, there's no reason it can't become more overvalued. If it's 100 times overvalued, why can't it be 1,000 times overvalued? If it's 1,000 times overvalued, why can't it be 10,000 times overvalued? So what you need is a catalyst to change that trend, if you will, and then you need the price action to support that. So whereas in the prior years, you could say, well, why didn't you start this fund 3 years ago when prices were even, or 2 years ago when prices were even more seemingly out of line? Now we have the 5-year note, the 10-year note at 285, I think is where it is, which seems like a big uptick from where it was, at just 20, 30 basis points a year or two ago. The difference is today we have a catalyst. We have the global central banks actually taking action, around the world, not just the U.S. Federal Reserve, but around the world to go from a liquidity infusion posture to a liquidity extraction posture, and doing so by ending quantitative easing, no longer re-upping each month to buy $95 billion worth of, fixed income securities, by raising interest rates, and who knows what other tools they'll use, and that'll depend upon the path of inflation going forward.
Yeah. And so you also have this challenge, of course, when you're thinking about constructing a portfolio. It's the quote usually attributed to John Maynard Keynes that markets can stay irrational longer than investors can stay solvent. How do you think about that structuring process? You mentioned at the top of the show that the goal is to benefit from the liquidity extraction while not losing money when markets go up. How do you think about that? What are some of the premises that you put in as you start to unpack that challenge?
Sure. So, I like to say that I'm not in the being right business. I'm in the money making business. So economics and economic theory and all the stuff we've been talking about so far is categorized under the being right business. Now the money making business is a completely different discipline. Even though I think the price action is supporting the broader trends to be going down in asset prices, whether it's stocks, bonds, and the like, I still have to put on my trading hat. I've been in the business for 32 years. I was a proprietary macro trader for some of the most prominent firms in the world, including Millennium Partners. But it's a different discipline to actually manage the position, because markets are going to go up, markets are going to go down. It's not going to be just a straight line down. Day like today, S&P is up 50 handles. I cut my losses, so it's very tactical. And then I'll reestablish when markets are weak. So it's very tactical trading rather than set it and forget it. So at the core, I'm a trader, where I'm trading from the short side. I basically have three postures, which is aggressively short, short, and flat. And I'm trying to manage my risk around the core thesis of wanting to be short, but at the same time, cutting my losses very quickly when markets are not, going in my favor. And so it's the implementation is very different than the overall thesis.
Yeah, we should say we're filming here on Monday, May 23rd, 2022, for a little bit of context on what's happening in today's markets.
Sure. At 11:18. So we don't know by the end of the day what it's going to be like.
Indeed. So let's talk a little bit about the types of securities that you guys are trading.
Sure. So what we've done is we've created, like I said before, I think a bit of an elegant solution to attempt to, because it really sounds like nirvana, make money when markets go down and try not to lose money when markets go up. So how are we doing that? Okay. So first of all, as mentioned, I'm trading the center book. Okay. That's really driving the performance of the strategy. And, I'm doing the best I can to make money when markets go down and use proper risk controls to avoid losses. Losses are going to be inevitable, but to try to minimize those losses when markets are going against me. Now, in addition to that, what we did was we put some other strategies in the book, in the fund, that are solely there to support my activities. So what I mean by that is that they are what I believe is either non-correlated or asymmetric to the upside, where hopefully they should generate some profitability and some profits while I'm doing poorly. So specifically, what I'm talking about are strategies like we have a pre-deal SPAC book. So it's nothing. We're not holding any SPACs through the de-SPACing event, but if we're buying SPACs at portfolio SPACs at 9.25, 9.50, if markets happen to go into a period of risk on, maybe those SPACs trade up to $10, 10.25, maybe the warrants become valuable. So we can generate a little bit of profit out of that book. But as I mentioned, it's very asymmetrical. So if markets go down, we can put the SPAC back to the sponsor at $10 a share. So it's, heads I win, tails I break even kind of thing. Another strategy in that category that we have is equity capital markets. So we have someone doing, IPO flipping, for lack of a better word, secondaries and blocks. And again, that's also a strategy that makes money generally when we're in bullish periods, because maybe the IPO window, which is shut now, will open up again for a little period of time, and some of the secondaries will perform better in the aftermarket, or there'll be some opportunities for block trades. And this is all very short term, even intraday type trading, but tends to do better when my center book trading might be more challenged. So that's hopefully going to generate some profitability for us. And then, we do have a core long equity position. It's large cap, deep value, kind of non-sexy, unloved, large cap stocks that was curated for us by, a very successful deep value manager. And the multiple on that is around 8. The PE ratio is about 8 on that portfolio versus, let's say, the S&P, which I think is around 19 right now. So, certainly if markets go down, that book will go down, but where's it going to go? It goes to 6 times earnings, 5 times earnings. I mean, this is a limited, amount of room that it's going to be able to go down if you've got these large cap, stalwart stocks, but they trade at 8 times earnings, and I'll be making a tremendous amount, through my tactical center book activity. So it's that balance that really helps us to achieve the goal of not losing much money, or any money, hopefully, if markets go up. So as I mentioned to you before the interview, we actually started this fund in April of 2021 with our own proprietary capital. And as you know, from April 21 to the end of December, the markets were quite strong. And, I took my foot off the gas pedal because I'm not a martyr. I'm not looking to short a market where the price action is not supporting my ability to make money from the short side. It becomes more difficult. So we ended up finishing up last year at up 20 basis points, which I think is a phenomenal performance in context of the fact that we're in the business of making money when markets go down. Market down 20, we're hoping to be up 40. Market up 20, we'd like to be plus or minus, 5%. If we're down 3%, market's up 20, we think that's a great performance. But last year, it happens to be that we ended up 20 basis points during the April to December period, when markets were quite strong. So we think that's just as impressive as right now, as of this moment, because I have real-time P&L, we're up 102% for the year, having made money in January, February, March, April, and now May. So we're able to, that's the objective of the fund: capitalize when markets are going down and when the price action is supporting being able to trade successfully from the short side, and try to protect capital as best as possible during periods when markets are going up. And it's very attractive to an investor because often investors have beta in their portfolio. So if we're flat and market's up 20, well, investors don't mind because they're making quite a bit of money from their beta exposure. When they really need us is periods like this, when the rest of their portfolio is struggling. We're a very additive opportunity for them.
Yeah. So let's talk a little bit about the center book strategy. What types of securities are you shorting there? Is it predominantly U.S. equities? Are you doing currencies, commodities, international stocks?
So it's very simple. It's I don't need to get too sophisticated about it. It's futures. It's all futures. So there's a few advantages to that. Number one, the tax treatment is better because it's 1256 contracts, which is 60% long-term, 40% short-term. Secondarily, those markets are very deep and very liquid, and they trade continuously, with the exception of Friday night and Saturday. The markets are 24-hour markets, unlike, single stocks, which close at 4 o'clock and reopen at 9:30 and are subject to idiosyncratic, gap risk and that sort of thing. So we're trading very simple. I'm trading very simple products: the S&P 500 futures, 10-year note futures, 5-year note futures, Bund futures, the DAX index, maybe some Japanese interest, not so much Japanese stuff yet because there hasn't been too much excitement, but I anticipate there may be. So it's those kind of products that we're trading, that I'm trading, to keep it pretty simple. And I like it because those markets are very deep and they're continuous, and I can manage the risk very tightly. Even overnight, I'm able to do stuff if I need to.
So let's walk through each one of those. You started out with S&P futures. Give us a little bit of a sense of what you see there.
Well, interest rates are going up, markets are going down. I mean, not in a smooth manner. We certainly have plenty of counter trend rallies. I mean, from the period of March 14th of this year to March 29th, we almost had almost a 500-point rally in the S&P 500, which is where, the skill comes in. I mean, I'm trying to be short and not lose a tremendous amount of money with the market going up 500 points. I think the market, if I don't have the numbers in front of me, but the S&P finished March up 3.5%. We actually finished up 6.5%. Now, if you look at the attribution of our performance, we actually did make a little bit of money in equities because I made money in the beginning of the month or the first half of the month, and then was very aggressive in terms of stopping myself out as markets were going against me, and then testing until markets sort of topped and came back down. But we made a lot of money shorting interest rates in March because interest rates, as much as stocks had a 500-point rally intra-month for the second half of the month, bonds kept going down. So we had a little bit of profit attribution from our S&P short activity, but we played good defense. But we continued to play offense in the fixed income side of the book.